For any given economy, financial conditions are typically determined by several factors. Specifically for the US, the focus tends to be on term interest rates and credit spreads, the strength of the US dollar, and, for some measures, the performance of equity markets. Whether the focus is on short-term changes or today is contrast against history matters a great deal in the assessment as well. From their recent peaks, the 2- and 10-year yields have respectively fallen 130 and 90 basis points. However, their current levels are still 2.5 and 1.5 times the average of the 5 years before the pandemic. The US dollar has also been supportive of financial conditions recently, the DXY index falling over 10% since its late 2022 peak. But compared to the 5 years prior to the pandemic, it is still 7% above average. Similarly, the S&P 500 is 11% up from its lows, but 17% below its 2021 peak. On all these typical measures, US financial conditions are materially tighter than pre-pandemic. Of course, these are not normal times. After the failure of Silicon Valley Bank and Signature Bank, and as the market speculates over the health of several other regional US financials, the US banking sector finds itself under duress, taking the contractionary stance of financial conditions to another level. At the end of 2022, US banks outside the 25 largest were responsible for around 40% of total credit supplied to the US economy by domestic banks. Moreover, the growth rate for credit provided by these smaller banks on a 6-month annualised basis was almost 3 times that for large banks. For commercial real estate loans only, it was a factor of 10. This rapid growth in credit made use of the strong pandemic deposit growth that peaked in late 2021. Since then, large bank deposit growth has begun to decline, while small banks' deposit books stalled. US bank credit growth was therefore already set to be a material headwind for the economy before the collapse of Silicon Valley Bank and Signature, and now it is an acute concern. In the first 2 weeks of March only, small bank deposits declined by $130 billion, equivalent to 2% of their total deposits. Importantly, this was not offset by a pickup in large bank deposits, which fell $9 billion or 0.1% over the fortnight. Note recent developments have also shaken confidence in large US banks, given Silicon Valley Bank was among the top 25 by assets in 2022, and as Signature Bank was just outside that group. With the US's future economic state increasingly uncertain and deposit funding now declining, a sharp deceleration in credit growth across the US economy seems almost certain. Arguably, the terms at which new lending occurs will also be tightened, particularly for highly cyclical parts of the economy such as commercial real estate, which had already seen a tightening of standards into 2023. While financial conditions analysis typically focuses on the price of capital and market liquidity, in this instance the FOMC and market participants must think more broadly, incorporating the flow of new credit and the terms at which it is lent into their decision making. Available data makes clear that there is strong justification for caution and, in time, likely cause to ease policy. This is behind our view that the FOMC should remain on hold for now and increasingly become focused on the downside risks to growth through the second half of this year as inflation risks subside. By itself, the shift in FOMC rhetoric will ease financial conditions through term interest rates and the US dollar, while also aiding confidence in the banks and the economy. From early 2024, after inflation risks have abated, the FOMC will be able to cut aggressively back towards a neutral level of policy, supporting growth in the economy and, further aided by improved regulation of smaller banks, confidence in the banking system. Once all these steps are complete, a full-fledged easing of financial conditions should proceed. We'll see you next time.